This is a review of the concept of inventory errors, and this is kind of a favorite place for examiners on the CPA exam because it allows them to test many different aspects of your knowledge. Uh, Inventory errors can be pretty problematic because they can have a material effect on your current assets and your working capital, your cost of goods sold, your net income, and equity. For example, if a purchase is not recorded and those goods are not included in ending inventory, cost of goods sold, which are beginning inventory plus purchases minus and ending inventory, and net income are unaffected, but our current assets and current liabilities are understated by that omission. Uh, if purchases and beginning inventory are properly recorded, but items are excluded from ending inventory, cost of goods sold is going to be overstated. Net income, inventory, retained earnings, working capital, and the current ratio will be understated. Uh, Another example, if goods are properly included in the ending inventory, but the purchase hasn't been recorded, net income is going to be overstated because the cost of goods sold is going to be understated. Also, we're going to find out current liabilities are understated and working capital is understated. Also, errors arising from recording transactions in the wrong period may end up reversing in the subsequent period, affecting both periods. So again, you need to be very familiar with this inventory formula: beginning inventory plus purchases minus ending inventory and cost of goods sold. In the next slide, you see a little bit of the interrelationships between an inventory error, because an inventory error can carry through from one inventory to another, from ending inventory to beginning inventory. Ending inventory can affect the balance sheet. Cost of goods sold can affect the net income statement. And the net income statement, then, if that's over understated, can affect the equity on the balance sheet. And again, obviously, any of the ratios that are impacted by these type of elements will also be affected. So it's a good idea to practice timing differences, or inventory type of, I shouldn't say timing differences, but inventory differences, and see how they impact the individual portions of the financial statements. So we're going to do 2 or 3 of these just for a little practice. Let's go with number 1. Canyon's beginning inventory was understated by $26,000 and its ending inventory was overstated by $52,000. As a result, Canyon's cost of goods sold for the year was, and you're given your choices. Go ahead and stop your video. Okay, and the answer is C. It's going to have been understated by $78,000. If we take a look at our inventory formula, our beginning inventory was understated by $26,000, and that's going to understate our cost of goods sold by $26,000. And our ending inventory was overstated by $52,000. And since that's a subtraction from our beginning inventory plus purchases, that's going to end up in understating cost of goods sold by $52,000. So that's going to result in an understatement of $78,000 basically in that particular year. Also, this isn't part of the answer, but consider the fact that the ending inventory was overstated by $52,000 in the current year, which means that the beginning inventory in the next year is going to be was also going to be overstated by 52,000, or the beginning inventory then will be overstated by $52,000, which will end up overstating cost of goods sold. Okay, let's try number 2. December 31st, Dunder Mifflin Corp. sold merchandise for $75,000 to Northern Harbor The terms of the sales were net 30, FOB shipping point, important thing, FOB shipping point. The merchandise was shipped on December 31st, year 1, and arrived on January 5th of year 2. Due to a clerical error, the sale was not recorded until January of year 2. And the merchandise was sold at a 25% markup, was included in Dunder Mifflin's inventory at December 31st, year 1. As a result, Dunder Mifflin's cost of goods sold for the year December 31 was, and again, go ahead and stop your video. Okay, in this case, the answer will be B, understated by $60,000, but we also have to go through the fact that we weren't given the cost of the inventory, we were given the sales price, so we have to back into it. We're told that there's a 25% markup on the inventory. So in this case, we take our $75,000 selling price divided by our markup of 1.25. That means our inventory cost would have been $60,000. If our inventory was overstated by $60,000, that would understate our cost of goods sold by $60,000. So again, the answer would be B, understated by $60,000. And that's the end of the multiple choice questions for inventory errors.